day-to-day responsibilities, the nature of the work, working with traders,
There's an income fund that grows its income over time by investing in UK companies.
Welcome back to Generation Gains. In today's video, we're going to dive into actionable strategies designed to help you maximize your investment returns in 2025. Whether you're a seasoned investor or just starting your financial journey, these tips will help you get the most out of your portfolio this year. So let's jump right into it. Over time, your investments can shift in value, meaning your portfolio might no longer match your original asset allocation. Rebalancing is the process of adjusting your portfolio back to your target allocation, ensuring it aligns with your risk tolerance and financial goals. Why is rebalancing important? Without it, you may end up with a portfolio that's either too risky or too conservative based on your initial goals. For example, if stocks have outperformed and now make up 80% of your portfolio, it might be time to sell a portion and reallocate to bonds, which could lower your overall risk. Regular rebalancing helps you maintain the correct mix of asset classes. It ensures that you're not overexposed to any one type of investment, protecting your portfolio against market volatility and preserving your long-term investment strategy. In 2025, tax-efficient investing is more important than ever. One of the most effective ways to optimize your returns is by contributing to tax-advantaged accounts like IRAs, Roth IRAs, and 401ks. Why should you use these accounts? They allow your investments to grow tax-deferred or even tax-free. With tax-deferred accounts like traditional IRAs and 401ks, you can delay taxes on your investment gains until you withdraw the funds. On the other hand, Roth accounts allow your investments to grow tax-free, meaning you'll never owe taxes on your gains if you follow the rules. By making regular contributions to tax-advantaged accounts, you give your investments more room to grow over time. It's like supercharging your returns by reducing the impact of taxes, allowing your money to work harder for you. Compound interest is one of the most powerful tools in investing. The concept is simple. You earn interest not just on your initial investment, but also on the interest that you've already earned. Why is compound interest so powerful? The longer you leave your money invested, the more pronounced the effects of compounding become. If you're not reinvesting your returns, you're missing out on the potential for exponential growth. Always reinvest dividends, interest, and capital gains so they can generate additional returns. The key to maximizing compound interest is time. The earlier you start, the more you benefit from this growth, which is why investing consistently is so important. If you're in it for the long haul, compounding can turn small, regular investments into substantial wealth over time. The old adage, "Don't put all your eggs in one basket," is critical to building a well-rounded investment strategy. But diversification isn't just about spreading your investments across different stocks. It's about allocating across different asset classes like stocks, bonds, real estate, and commodities. Why is diversification important? It helps reduce risk by ensuring that your portfolio isn't overly reliant on any single investment type or sector. When one asset class performs poorly, others may be doing well, helping to balance out your returns. For example, when the stock market is down, bonds or real estate might be doing well, acting as a buffer. Diversifying across different asset classes also helps capture growth in multiple areas of the economy, leading to more stable, consistent returns over time. Dollar cost averaging, DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This method helps mitigate the risk of market volatility by ensuring you don't invest a large lump sum at a potentially unfavorable time. Why should you use DCA? By investing consistently, you smooth out the ups and downs of the market. Over time, this can lower your average cost per share, making it a great way to maximize your returns without trying to time the market. DCA is particularly useful in volatile markets because it takes the emotion out of investing. Instead of panicking during market downturns or trying to chase after the latest trend, you stick to a regular investment schedule. The consistency helps you stay focused on the long-term goals of building wealth. Investment fees can erode your returns over time. Even seemingly small differences in fees can add up significantly over the long term. That's why focusing on low-cost investments is a smart strategy to maximize your returns. Why is it important to minimize fees? High fees, especially those associated with actively managed funds, can eat into your overall returns. On the other hand, low-cost investments like index funds and ETFs typically have much lower expense ratios, allowing you to keep more of your money working for you. Index funds and ETFs provide broad market exposure with a passive management style, which is why they tend to have lower fees. Over time, this can make a substantial difference in your total returns, so aim to keep costs as low as possible without sacrificing diversification. It's easy to let emotions drive your investment decisions, especially during market downturns or when there's a fear of missing out on the latest trend. However, emotional investing can lead to poor outcomes like panic selling during a market dip or chasing after overhyped stocks. The key to successful investing is sticking to your long-term strategy, even when the market gets volatile. The stock market has historically risen over time, despite short-term downturns. By focusing on the bigger picture and keeping your emotions in check, you can avoid making knee-jerk decisions that hurt your returns. Patience is one of the most important virtues for an investor. Instead of reacting to short-term market movements, stay focused on your long-term goals and stick to your investment plan. If you're invested in dividend-paying stocks or funds, one of the best strategies to maximize your returns is by reinvesting those dividends. This process involves using your dividends to buy more shares, rather than cashing them out. Why should you reinvest dividends? By reinvesting your dividends, you're purchasing more shares, which means you'll receive even more dividends in the future. This compounding effect helps grow your portfolio faster and can significantly boost your long-term returns. Many brokerage platforms offer automatic dividend reinvestment plans, DRIPs, which make it easy to reinvest your dividends without any extra effort on your part. If you're looking for a simple way to turbocharge your investment growth, reinvesting dividends is a powerful strategy. Timing the market is one of the biggest mistakes many investors make. The truth is, no one can predict when the market will rise or fall. Trying to time the market perfectly often leads to missed opportunities or poor timing. Instead of focusing on trying to predict short-term market movements, shift your focus to long-term investing. Use strategies like dollar-cost averaging to take the guesswork out of the equation. By investing regularly, you can avoid the risks of market timing while ensuring steady portfolio growth over time. If you focus on long-term sustainable growth rather than short-term fluctuations, you'll see much better returns in the future. Don't waste your time trying to time the market. Stick to your strategy and let your investments grow naturally. 10. Keep learning and stay informed. The more you know, the better decisions you can make. Continuous learning is key to staying ahead in the world of investing. Whether it's keeping up with market trends, learning new investment strategies, or understanding personal finance tips, staying informed gives you an edge. In 2025, the financial landscape will continue to evolve. Staying on top of these changes will allow you to adapt your strategy and make more informed decisions. Whether you're reading financial books, following investment blogs, or watching educational content like this, make learning a part of your investing journey. The more knowledge you have, the more confident and capable you'll feel when making investment decisions. The best investors are always learning and adapting to new trends, and you can do the same. To quickly recap, here are the top 10 strategies to maximize your investment returns in 2025. Rebalance your portfolio regularly. Take advantage of tax-advantaged accounts. Leverage compound interest. Diversify across different asset classes. Consider dollar-cost averaging. Focus on low-cost investments. Avoid emotional investing. Reinvest your dividends. Avoid trying to time the market. Keep learning and stay informed. By following these strategies, you'll be well on your way to optimizing your investment returns in 2025 and beyond. If you found this video helpful, don't forget to hit the like button and subscribe to Generation Gains for more tips and strategies. What's your favorite investment strategy for 2025? Let us know in the comments below. Thanks for watching, and we'll see you in the next video.